Let me explain the differences between active and dormant accounts. Basically what we're talking about here is this. If you have an account that you put money into on a monthly basis, maybe through your current employer or any other type of investment program, if you're putting money into it on a monthly basis, that's considered an active account because obviously you're actively contributing to it each and every month. Now the opposite of that would be a dormant account. And a dormant account is any account that you have that you do not put money into at least on a monthly basis. That's the key. So it could be a previous employer's retirement plan that you never rolled over, or maybe you did roll it over but you're no longer contributing to it. Those types of accounts are considered dormant. And what ends up happening more often than not is I see that advisors will basically treat active accounts and dormant accounts exactly the same, when in reality you really shouldn't. You should have a different strategy for an account that you're adding money to on a monthly basis versus an account that you're not adding any money to. And let me go over an example as to why. So if we take a look at the stock market over time, if we basically simplify it a little bit, we know that the market goes up and goes down. So if you're actively contributing, if you're putting money into that account each and every year, what you do is you get to basically take advantage of what's called dollar cost averaging. And that means that you're putting money into the market or into possibly the mutual fund if you have a 401k or a 403b, something of that nature. You're putting money into it when the market's low, and then you're buying it when it's a little bit higher, and then you're maybe buying a little bit here, but that's okay because then as the market goes back down again, you're still putting money in when it's low. So what ends up happening over time is you get to take advantage of the volatility in the market, meaning you don't like it when the stock market goes down. Nobody likes to see that, but if you're actively contributing to the account, you're actually getting to take advantage of that a little bit because you're taking advantage of the volatility, meaning you're buying more shares at a lower price when the market went down, and that will actually help you recover more quickly then when the market goes up. So in an actively funded account, again, maybe a 401k, 403b, any other type of investment program where you're putting money in monthly, having this type of volatility can be okay. And where we see this more often than not, obviously, is going to be with mutual funds. Most 401k plans, 403b plans will be strictly invested in mutual funds, and that can be an okay time to use mutual funds. It's not necessarily bad because you're able to take advantage of the volatility. However, whenever you have the opportunity to roll those types of dollars, either in a 403b or a 401k, over to an IRA, we usually recommend that you take that opportunity. And the reason why is because once we move into an IRA, typically it's going to become a dormant account, meaning you're no longer putting any money into it. And the IRA is going to have some advantages. You basically have more options than what you used to have when you had the money in your employer's plan. So mutual funds are still an option if you want to contribute monthly to the IRA. More often than not, you're no longer going to put any additional contributions in the IRA. So now you have other things that you can invest in, maybe exchange-traded funds or annuities, or maybe individual stocks or bonds, real estate investment trusts, really almost anything that you can think of. You have more options. And what you can do with an IRA, since you're no longer contributing to it, is you can add safety nets to that money. Meaning when we have a situation where the stock market starts to go down, again, you're not taking advantage of that volatility. So what you want to do then is protect the principal. You want to protect and preserve the principal that you have built up in the account. Because again, unlike when you were actively contributing, there's no advantage to you when the market loses value. If you're fully invested, you're not able to take advantage of it. So what you want to have is safety nets. One of the things we do at our firm is we use something that's called a stop loss. Not with every position or every investment that we use, but a stop loss is basically something that when things surprise us in the market or in the economy and the market starts to react and go down, well, basically that position can be sold and just moved to cash. And in particular, when it's inside of an IRA, that's possibly a good strategy to follow because there's no tax consequences of doing that. Obviously, the IRA is just growing tax deferred. So if the position is sold, you don't have to worry about paying any additional taxes. So it's a strategy that works really nicely, and it's something that we definitely recommend individuals that are definitely within about 10 years of retirement going ahead and taking advantage of the options that you might have that would be a little better inside of an IRA than, say, just a regular mutual fund. So again, when you have an active account, it's okay to use mutual funds. Once the account becomes dormant, you usually want to avoid things like mutual funds where you're just left to the mercy of the market, and you want to have some sort of an investment that is going to have a built-in safety feature, or if not, then again, work with a firm like ourselves where we could possibly use a stop loss on it. Because what ends up happening is if you have a dormant account invested directly in the stock market, maybe with mutual funds, what will happen is as the market's volatile, you're not using that volatility to your advantage, and the fees and expenses that you have to pay end up kind of acting like an anchor over time. So this is an issue that's misunderstood by a lot of individuals. Even a lot of financial advisors don't necessarily understand the differences between active and dormant accounts. So this is why my book on retirement planning, I spent an entire chapter covering this specific example in detail.